Bismillahirrahmanirrahim. Welcome to my business educational platform. I hope you understood the last lecture concepts that were about dividend growth models that include the constant growth model, zero growth model, and the variable growth model. In today's lecture, we will cover the risk and return. So, in today's lecture, we will discuss what is the risk and what the return is, using probability distribution to measure risk, attitude towards risk and risk return in a portfolio context, diversification, the capital asset pricing model. So, what is the risk? Risk is something that we can define it. Suppose you make an investment in a company and you are expecting that you will be getting 22% of the return, but in actual you get what? You get the 18%. The 4% you miss, that is the risk. It is missing due to the risk. So risk cuts the outcomes that is totally expected. So the basic premise of investment is risk and return. So you will make the investment, certainly there will be the risk. Investment is something that is money spent with. So you will make the investment in order to get some returns in future. So what is the return? Return is amount received. We will subtract the amount invested, then we will come to an end the return. So if we want to find out the rate of return or the percentage of the return, then simply we will use the amount received minus amount invested divided by amount invested. So how we can define the return? It is income received on an investment plus any change in market price, usually expressed as percentage of beginning market price of the investment. So it is same the formula which we discussed in our previous slide, with slight differentiation in d plus dt plus pt minus 1 divided by pt minus 1. Pt is the current price, pt minus 1 is the previous price divided by previous price, where dt represents the dividend that we will be getting on the return. So now we are moving forward to the risk and return. So what is the risk and what is the return? So you will make the investment, there will be the investment in a single portfolio, or you will make the investment in the portfolio. So as per the proverb, do not put all eggs into the one basket. If one basket will be broken, certainly all the eggs will be broken. So same is the case here. You cannot put the investment into the one portfolio. You have to diversify your portfolio. So certainly there will be risk involved with the single portfolio, and there will be risk involved with the portfolio. So with a single portfolio you will face the standalone risk and standalone return. With the portfolio you will face the portfolio risk and the portfolio return. So what is the standalone expected return? It is the expected rate of return on asset is the weighted average of possible outcomes on an investment with weights being probabilities. So R cap is the expected rate of return, which we can find out using R1 P1 plus R2 P2 plus up to Rn Pn, which means we can sum up all the probabilities with the actual rate of return. R1 is the actual rate of return, P1 is the probability that will be assigned to that return. If we will sum up all these probabilities by multiplying it with actual return, then we will come to a expected rate of return, that is R cap. So how we can determine it? We will simply sum up all the probabilities with the actual rate of return. So R cap is the expected rate of return on asset, Ri is the return for the highest possibility or the actual return, P1 is the probability of returning occurring, N is the number of possibilities. So if we will use the 10 as 10 years, then we will put n equal to 3, n equal to 10. If we will use it for 3, then n will be 3. So n is the actual number of possibilities that will be assigned. So I hope you understood how we can calculate the expected rate of return. So here is an example. Suppose stock BW has the actual rate of return of minus 0.15, minus 0.03, minus 0.09 and 0.21, 0.33, and the probability is 0.1, 0.2, 0.4, 0.2, 0.1. So if we will multiply with actual rate of return, we will get 0.15, and if we will sum up all, we will come to an end of 0.09 or 9%. So expected rate of return for the basket wonder is 9% or 0.09. I hope you understood how to calculate the expected rate of return. So now we are moving forward to the risk. What the risk is? The variability of returns from those that are expected. If you expect something and there is some variability involved in it, then certainly it is the risk. What is rate of return do you expect on your investment saving this year? What rate will actually earn? Does it matter if it is a bank certificate deposit or a share of stock? Yes, it certainly matters. So if you will make the investment in single portfolio, certainly you will be facing the standalone risk. Standalone risk is the probability that the actual return would be different from the expected return. So how we can calculate it? We can calculate it using the standard deviation formula by using Ri. Ri represent the actual rate of return, R cap represent the expected rate of return, which we will multiply with the probabilities. We will come to an end the expected return and we will multiply it with pi, then we will come to an end with the standalone risk. So I hope you understood how to calculate the standalone risk. Standard deviation is the statistical measure of the variability of a distribution around its mean. It is the square root of variance. So how far the data lies about the mean. So it is standard deviation shows the how data lies far from the mean. So here is an example of finding out the standalone risk. So simply what we have to do, we have used the same example which we are continuing from our lecture. So here it is the 0.9% rate of return, expected rate of return, and simply we will minus it with from the actual return and multiply with the probability, we will get 0.01728. So what is the standalone risk then? Then standalone risk will be simply, if we will put it in the square root, we will find out the standalone risk. So what will be the square root of 0.1728? It will be the risk. So I hope you understood the idea behind standalone risk. Now we are moving forward to the coefficient of variation. What is the coefficient of variation? The ratio of standard deviation of a distribution to the mean of that distribution. It is measure of relative risk. So coefficient is used for relative risk. If we are comparing two stocks, so we will use the coefficient of variation. If the stocks are providing the same return but the different risk, so we will use the coefficient of variation between in order to choose the best portfolio or best stock or the best standalone product or the portfolio. So what is the coefficient of variance for the basket wonder? It is 1.46. So if we will use any other portfolio or the standalone stock, so we will compare its coefficient and we will use whether to invest in a stock or not. So what is the coefficient of variation? It is 65% of mean and 15% lies, the data lies beyond the means. So it is 18% to minus 50%. So how it is far from? If we will add 15% plus 65%, we will come to 18%. If we will subtract minus 65%, we will come to minus 15%. So coefficient of variance shows risk per unit of return. The lower the coefficient of variance, will be the better to invest. So I hope you understood the concept behind the standalone risk and the return. So till now, Allah Hafiz. Don't forget to like, subscribe and press the bell icon button so that you can never miss any update from my channel. Till now, Allah Hafiz. See you in next lecture.